Okay, ladies and gents, we are now moving to our next panel. So please join me in welcoming Khalid Talukder, which is the CEO of DKK Partners, Alex Barr, partner head of Sarasin, Bread Street, James Rotchford, Principal Blue Owl Capital, Daniel A. Batzlen, CEO of Parkside Capital Group, and Jason Ferrante, managing partner, Repower Holdings.
So, good afternoon, everyone, and welcome to the second session this afternoon of the UK-GCC Private Capital Annual Investment Summit. Today, we'll be diving into macroeconomic forces, from inflation to interest rates with our panel, geopolitical dynamics. It's been quite an interesting couple of months, I think people agree, into the global economic stage. Tariffs, I think, come to mind, but also the sort of union between the UK and the EU finally post-Brexit, a decade on. But more importantly, really sort of reshaping the real estate investment strategies across key global markets. But before we start and begin, let's have an introduction for each of our panelists, if we go from right to left. So please, if you may.
Thank you very much indeed. I'm Alex Barr. I run a business called Sarasin Bread Street, which is the private markets division of Sarasin and Partners LLP, which is a leading UK wealth manager. I have a long background in institutional asset management in the UK, with a particularly long spell at Aberdeen Asset Management, where I was head of private equity and then subsequently ran Aberdeen's global oversight function for its entire private markets and real estate business. That's it from me.
Hi, everyone. James Rotchford from Blue Owl. Blue Owl is a listed alternative asset manager. We manage about 270 billion AUM across three main strategies: private credit or direct lending, GP stakes, and real assets. I work in our real assets business, specifically focused on European net lease investment opportunities.
Jason Ferrante with Repower Holdings. 25 years in commercial real estate finance, debt advisory, and currently private equity investment.
Daniel Batzlen. I'm running a family office with 1 billion assets under management, located in Switzerland, Zurich. And we have experienced more than 20 years in real estate investment in Switzerland.
Thank you, everyone. So, Daniel, since you were the last to introduce yourself, let's kick off with our first question, and hopefully you've taken some time to look through the topics of discussion this afternoon. In your opinion, how are macroeconomic indicators such as GDP growth, inflation, and recession risk influencing the real estate investment sentiment globally, and particularly in your area of focus?
Well, if something happens in the European Union, of course, there you have an impact to Switzerland. And well, what we have seen during since the beginning of the Ukraine war, we have seen inflation rates about 10. For instance, in Austria, we have seen 11% inflation rate per year. And well, it's quite interesting. We didn't have such high inflation rates in Switzerland. It was up to 2.53%. And well, it makes more expensive all the goods from the European Union imported to Switzerland. So if European Union will happen something there, there is an impact to Switzerland.
Thank you. James?
So I think what we've seen is on the capital side, a bit of a shift in emphasis of what our investors and other investors are looking for. I think if you go back a year or 2 years, there was still a fair bit of emphasis on growth opportunities. So, reversionary logistics opportunities. I think we've certainly seen that change to more of a defensive, income-oriented approach on the investment side. And then I think we've also seen from an opportunity set perspective, the market change a fair bit. So, as we've seen the market slow down, we've seen the impact of tariffs. We've seen a lot more opportunities coming out of corporates. We do a lot of sale and leaseback transactions with corporates. I think the The volatility that we've seen, particularly at the beginning of this year, has put a lot of corporates on the back foot from a financial planning perspective. And they had their budgets that they came up with at the end of last year for the start of this year, and in many ways those budgets are now irrelevant because so much has changed from a planning perspective. So we're seeing more opportunity come out of those corporates from a sale and leaseback perspective, partially driven by this volatility.
Thank you. Alex, given the various comments of our fellow panelists, is it something that you would concur with, or have you seen some sort of different inferences and observations as we work through these macroeconomic challenges?
I mean, I don't disagree with any of the comments. I think they're all spot on, and I think I sort of try and characterise it from a UK perspective of one of cautious optimism. And I'm just going to make one broader, bigger picture point, which isn't necessarily, directly, linked to the specifics of your question, but it is a very key driver to investor sentiment to the asset class in the UK, which is, for years and years, real estate has been, part of a multi-asset allocation from institutional investors' perspective. But I guess what's really changed over the last, I'd even kind of put it in the last sort of 5 to 7 years, is that most institutional investors tend to think of real estate as part of a broader private markets allocation. And we've seen a seismic shift towards positive private market sentiment in the UK really over the last 5 years. And you've seen, specifically on the private equity side of things, the Mansion House Compact and then the Mansion House Accord driving positive sentiment from very large institutional investors in the UK. Now, I guess the longer term threat, and I don't see it immediately, is that you start to see more traditional real estate allocations potentially squeezed a little bit by greater forced allocation to private equity and venture, partly for political reasons. I don't think that's happening anytime soon. I think that it is still very much part of this broader zeitgeist towards private markets, and that's driving institutional allocations. So that's got to find a home somewhere. And we've heard from infrastructure investors on the previous panel. We've got professional real estate investors here. We've got some very interesting, differentiated commercial opportunities here in the UK, riding on the back of some really important global trends. So I said at the start, cautiously optimistic, reiterate with that view.
Thank you. That's incredibly comprehensive. And finally, over to you, Jason.
Which aspect do you want me to talk about?
I think essentially, probably from an macroeconomic perspective, the sort of biggest economy in the world being the US, and the way that it's, let's say, shaking up the apple cart. What is the sort of compound, let's say, ripples that are going across the major sort of real estate investment areas, and let's say investor confidence, investor sentiment? What are you seeing, or what would you predict over the next sort of 6 to 9 months?
Well, it goes without saying any type of development right now is kind of off the table, which is to say that there's a good bid under the built environment. So really the value add plays is which we see a lot of opportunity, particularly in the student housing area, cold storage. The data center play, in my opinion, is it's a little bit long in the tooth. I feel that there's just not enough energy to supply the demand for that, and there's going to be a reallocation of resources to other segments of commercial real estate. In every market, up market or down market, there's always opportunities to invest, and particularly with this market, I think the smarter investors are taking a shot at migration flows and more climate resilient markets.
Yes, just building on that, you've raised some very important points there. But from a sort of pragmatic and practical perspective, what is your observation on, let's say, the deal flow book that you guys are actively looking at and managing? Are you seeing a slowdown, a stagnation, something that will pick up, or you're just saying it's a wait and see strategy?
Say the last part again.
if it's a wait-and-see strategy to see what happens in terms of the deal flow book?
Well, I certainly would development, wait and see. But, money always has to be put to work, right? If you're managing money, you have to figure out a way to put it out the door. So, yeah.
Daniel, your view?
I guess to pick up this point, wait and see. So we have seen the decision have been made in the US overnight, and the next night, and the next night. And so maybe it's a kind of way to sit and wait, because you don't know what is upcoming next.
Alex?
I mean, the only point out, we've seen extraordinary market volatility this year, perhaps unprecedented in recent years, and our own experience at Bread Street is that after periods like that, you tend to see an element of reshaping and resizing of portfolios. We're already starting to see a lot of very differentiated deal flow from some of those strategic asset allocation changes, investors making decisions based on some very fundamental moves that have happened over the last few months. And we expect that to just manifest itself in increasing deal flow over the next year.
Great stuff. Well, look, that's a very good, solid base to work on in terms of the next set of questions that we're going to go through in the next sort of 20, 25 minutes. I now sort of ask your views, and I think I'll start with yourself here, Jason, about interest rates. And with different central banks taking different strategies, how is that impacting investment strategies from what you're seeing, and then B, globally going forwards?
Well, my personal opinion on interest rates, they're going to go higher before they go lower. I think that's going to, obviously create a disruption in the market. But yeah, I think the Fed is going to come to the rescue, and probably the back half of the year we'll see lower rates.
Alex?
Well, I'm going to come at this really from just a UK environment, and our central view is that we'll see a lot of the investment landscape being completely reshaped by what are probably trending interest rates downwards in the UK. So, we've got mortgage rates probably going to stabilise in the UK down to around 4 to 5%, and I think our central view is we'll see commercial property values rebound a little bit as we see debt costs fall a little bit. I think we saw in March month on month total returns up about 0.8% for commercial, office and industrial property in the UK. So I wouldn't necessarily extrapolate that on a month by month basis, but I expect to see I'd hope to see rate cuts really supporting refi activity and sort of further development in that space.
Thanks. From a sort of UK-centric perspective, it's very clear, and I think from my own personal observations, I do see that myself. James, from your perspective, what are you seeing out there, given the sort of disharmony between the Fed, ECB, and the Bank of England at this point in time?
So I think maybe tying together the prior question as well about what we're seeing from an opportunity set perspective and how it ties into rates. I think we've seen a fundamental change in who's coming to the market with transactions, and I think part of that is because we've seen the consensus around where rates are going in the short term or even perhaps the medium term disrupted a little bit by tariffs, interest rate volatility that we've seen in continental Europe as well. So I would say, from a deal flow perspective, most of the transactions that we're seeing now, which are interesting to us, are groups that are sellers at today's price, for lack of a better term. I think when the consensus had been, for the better part of the last year and a half, maybe up until March of this year, that rates were heading down, and heading down on a relatively straightforward path. Most transactions that we were seeing were coming to market, and people were essentially asking you to pay tomorrow's price on the basis that rates were heading in that direction. I think we're seeing a lot more sellers now who are willing to say, what's the price today? If it's a marketed process, give me price transparency, and I'm a seller at today's price. So in some ways, it's kind of shrunk deal volume, but in other ways, it's made it a little bit easier to focus on the right transactions. I think in terms of the direction of yields from here, I think for us, we have a view on these things and we have a house view, but when there's as much uncertainty about the direction of rates, you've suggested that rates are probably going down. That would probably be my base case view as well. You've mentioned that they may go up from here, and I certainly can understand that perspective. For us, we're really looking for, to the extent that we can, we're looking for transactions where staying quite disciplined on unlevered yields, we feel like we're buying at good value. So putting a little bit less emphasis on how we hit our returns with financing is the approach that we're trying to take right now, with a little bit of uncertainty around the direction of travel, with the rates in the short to medium term.
Thank you. And Daniel, having heard our fellow panelists with their interesting observations, but I think in the challenging environment that we're in, what do you see from a debt financing challenge, given the sort of, let's say, different strategies that the various central banks are sort of playing out at this point in time?
Well, you ask for different strategies of central banks, and well, I don't want to change the role at the moment with the boss of the Swiss National Bank. Due to the strong Swiss franc, it's quite difficult to build up and establish strategy against this trend. And in Switzerland we have the inflation rate is about 0.3%,
it's very low.
and the key interest rate is 0.25, and they talk about the zero at the end of June, maybe end of September, and in December they talk about negative interest rates. So this is what we have seen some years ago, and well, to be honest, it's well, I don't want to change the role with the boss of the Swiss National Bank. So I guess each decision he will do is a kind of way it's wrong what he will do,
No, that's all very clear, and I think again there is going to be some interesting plays done by the central banks over the next sort of, with the exception of your lucky Swiss in terms of what you have.
Well, I don't know if this is lucky or not. It depends on the perspective. What do you have view on that? Yeah.
Moving on to our next question here, and this is more about the rising costs of living and housing shortages that we see, especially more so in the developed world, in the major cities. I know London's got a significant crisis, Manchester, Birmingham, large cities. I see Spain have started to clamp down on Airbnb type activity as well. Expats being potentially levied 100% tax on their purchase of their property. With that, and with flexible working practices, there's two questions. There's a residential and there's a commercial aspect to it. How is that really now defining post-COVID era real estate investments? I think Alex, to kick off, if you can.
So it's a great question, and I think the challenge is going to be trying to keep us quiet on this one. I mean, I'll give you kind of an overarching view here, which is I think all of that creates headwinds, but also opportunities, and investors are going to have to be, I think, particularly agile as they navigate that. Just picking up on the first one, kind of the resi sector. We face a long-term persistent housing shortage in this country, and that's driving demand for new builds. It's driving affordable housing. People are changing the way they live, much more single occupancy. But one of there are clearly very significant local political challenges to developing the UK's housing stock, but it's also accentuated by very significant mission-critical shortage of infrastructure, particularly around wastewater and sewage and the road networks. There's no overnight fix to that, and that's kind of part of the headwind answer, part of the opportunities answer. So, there really is no immediate fix to that, and I expect that to persist. Clearly a very strong government-mandated drive to increase the housing stock side of things. Kind of on the second piece, the commercial side of things. We've made several comments as a panel already on the outlook for the logistics and data warehouses sector. We are going through an extraordinary global recalibration of supply chain logistics and supply chain management. I think there are profound implications for warehousing and logistics bases in the UK as they adapt to that. So I think we will see greater repurposing of existing assets. We are going to probably have to have, we're going to have new developments to try and meet that new, shape of things to come. Greater inventory, management and collation within the UK. So big challenges there. And I think the final piece of this, and I sit in an office that round the corner, overlooking St Paul's, which looks great from the outside, but it's a office that was built at the turn of the last century, so it's nearly 25 years old now. So it's a great example of an office that needs very substantial, ESG reconfiguring, which is going to drive a lot of redevelopment in the city. The financial city where we are at the moment is booming. It's very, very hard to find really high quality, office space configured to the needs of a modern working organisation. And I think most organisations are still trying to work that out. If you're JP Morgan, you're back 5 days a week. But if you're an organisation like us, we value the flexibility and nimbleness that comes from empowering staff to work as and how they want to do that. So, with the UK commercial infrastructure, particularly the office environment, needs to be able to cater for kind of all flavours there. Again, I think the genie's out of the bottle. Flexible working is very much here to stay. So lots of comment there.
I think it is, and I think it's look. There's a lot of societal trends that are taking place. A lot of different forces at play, but. No, I think there's some, especially from a UK perspective, my own personal experience, I'm seeing a lot of these observations. Over to you, Daniel. What are you seeing or observing based on two-part question, residential and commercial?
Please repeat the question again.
So from the cost of living perspective, the impact on investment or real estate investment in the residential sector, and then also from a commercial perspective in office real estate, the sort of flexible working arrangements that have become more accelerated post the COVID era.
Well, it has been discussed today a lot of the energy transition, and I guess one of the biggest sectors there must be urgently an energy transition is the real estate sector, and so I guess the ESG criteria, we must fulfill the criteria as soon as possible. I'm not an expert in climate change, but even me feel that every day it became warmer over the last years. And we need a transition there. And what you mentioned is the second rent. This is the additional cost for your rent. So if you have an older property, the additional cost for heating warm water increased over the last years. So it's necessary that the owner, the investors, are highly more focused on ESG criteria to increase the net rent and reduce the additional costs. So it makes sense to, do the transition of energy as soon as possible.
But do you think that may be driven a little bit differently in terms of behaviors based on the question asked previously in terms of interest rate conditions, where if you're in a high interest rate environment, your appetite for ESG may be a little bit less than in a low interest rate condition where you've got the affordability of borrowing cheaply to renovate or redesign your property to make it more efficient. That's why I see a divergence personally.
Absolutely. So I guess the panel before or the other before, it was the sentence that ESG, properties who fulfill all ESG criteria have a higher value than the properties they don't fulfill all the ESG criteria, and makes sense. So we must follow that way, that properties who fulfill the ESG criteria have higher value than the others. As from an investment perspective.
I understand. So I think it leads me nicely on to Jason here. Obviously, the US administration is a drill baby drill type sentiment where ESG are kind of taken a back seat. It hasn't gone completely, but there are other priorities in terms of aggressive building, creating jobs, making America great again, bringing investment back into the US. I don't hear any of the White House press secretary talking about ESG, right?
Yeah, I think the term ESG is kind of off the table.
Yep.
I think the term that is being used is sustainable, and I think sustainable is, means something to everyone, but universally, it's just that. You want to have an investment that will kind of be an all-weather investment, no pun intended. And I think that's ultimately the awakening that I'm waiting for, and I think that's going to continually happen, particularly because it's my view that we're in a new regime, and the cost of everything is going to stay high, unless we have a depression, and then interest rates go down. But I think that's the reality, and I don't think, with debt levels this high, there's really no room for a great weakening that is needed to bring asset prices down to a level that generally things are more affordable. So the reality is people are going to have to become more and more creative, find ways to transition and cost cut. And that's, you'll be seeing that through all of commercial real estate and probably broadly as well.
James, and finally to you in terms of the thoughts of your fellow panelists, and
sure,
quite good material there to work on, I believe.
Yeah, sure. So maybe just starting with the question around resi assets and commercial assets and impact of kind of work from home. We don't do much in the pure play residential space, but I think we do think about residential as it relates to the commercial assets that we invest in. So we invest in a lot of essential retail assets. I think increasingly we're spending time thinking about given the shortage of housing here, where we can be investing in essential retail assets that are in rapidly growing catchment areas, right? If the UK is going to build as many homes as they're planning on building, they're going to have to go somewhere. And to the extent that we own grocery assets or other essential retail assets, we want to be focused on the areas where new homes are going to be being built. As it relates to other commercial sectors, I think we've seen work from home fundamentally change behavior around certain leisure assets. So the pub sector is a major commercial property sector here in the UK. I think if you had walked around City of London on a Friday in 2019, you would have seen a very, very different footfall pattern than you'll see at City of London pubs now on a Friday. That activity tends to happen more on Wednesdays and Thursdays, and it tends to be your more residential neighborhoods that have higher footfall at pubs, for example, or other leisure assets on Friday. So we've obviously taken note of those behavior patterns and the way we look at assets, leisure assets in particular, has been impacted. And then I think on the ESG point, what I would say is probably the most the largest impact that we've seen is on the financing side, right? I think LPs led in many ways on ESG criteria, but banks also led in many ways, and there were certain asset classes that were very, very difficult to finance prior to what I would call a bit of a sea change in the way people think about ESG. EPC requirements and building sustainability is still very, very important for our financing counterparties, but there's less emphasis on the specific sectors of the tenants that are operating out of those assets. I think defense assets in particular were particularly hard to finance, or assets that were occupied by defense or defense adjacent tenants, and we've seen a pretty material change, particularly from European financing counterparties and appetite in pricing for financing assets in that asset class or other similar asset classes. So, we've seen a big change on the ESG side.
Great stuff. Well, look, a secret I need to share with the panel is I'm actually an FX guy. So the next question is going to be an FX question, right? I had to get one in for the FX cap markets fraternity. So, given this is a UK-GCC investment forum, not forgetting that, and the flows of capital between both of the geographies, how are currency movements and capital flow dynamics impacting cross-border investments? And I'd like to consider three parts to answering that question. The strength of the US dollar and euro volatility, obviously. The GCC outbound investment strategies, in particular sovereign wealth funds and high net worth and ultra high net worth individuals. Currency hedging costs, which was my job for 20 years that I did. And risk aversion. And I think I'd like to start with Jason on that.
I'm going to pass on that one.
Okay.
Why don't I have a go at picking this one up for you? I mean, I think I got to sort of just make an opening point here, which, and I'm going to come at it again from the UK piece first of all, is that we've said for many years, and we as brand UK, and I'll come to your specific questions in a second, that but it does relate to outbound investment strategy into the UK particularly. We think of ourselves as a magnet for global capital for all sorts of very sensible reasons, strong legal protections, the rule of law, regulatory clarity, etc. I think that's true, but I think the great danger is that we are complacent around that. And whilst sterling has, I'd stop short of saying it's been stable post-Brexit. It's had its, certainly had its fall, and there have been tactical entry points for that. I think long term, I think we have to think very, very clearly about that big selling point is very true, but I just think there needs to be something fundamentally more attractive to the UK economy for that to continue to play out. From a point of view of, I'm not going to offer a view on USD Euro volatility again. I've long taken the view that as a private markets investor, my job is to look through currency volatility. We're probably sitting at opposite ends of the spectrum from that. But from the GCC outbound investment piece, I think that we have to just be very thoughtful around what is the attraction here. We've covered off already huge amounts of the private real estate potential investment spectrum already in terms of the attraction here. But I think others in the room will be better placed than I am to have a view on whether that continues to be attractive. But I think prime commercial real estate, prime residential real estate continue to be a very attractive, relatively safe asset in an otherwise extremely volatile, currency volatile world.
Very good. James?
I think from a capital flows perspective, I think in terms of rates and FX, we have seen, I would say, a meaningful uptick in appetite from both Middle Eastern, Far East, and U.S. investors and LPs in pure play euro-denominated strategies. That's also with some UK exposure as well, but fundamentally a euro-denominated fund. I think it's been in the press that some of our peers as well had particular success raising capital from U.S. denominated and Middle East and Far East investors in some of their euro-focused vehicles. So I think that is a trend that we're seeing. I think we were probably seeing that trend before the beginning of this year, but I think as we have conversations with LPs around why they're interested in further exposure in Europe. I think two things. One is, rates were lower for longer here than they were in the U.S. And prior to COVID, we did kind of enter into a rate hiking cycle. Obviously we all ended back up at zero during COVID. But I think the prolonged zero interest rate environment here, for certain overseas investors, made things look relatively unattractive on kind of a going-in unlevered yield perspective, particularly if you invest in stable income-oriented net lease investments like us. I think a lot of the LPs that we speak to today feel like now is a very interesting time cyclically in the market to be buying into income-oriented product because yields are candidly higher than they have been for quite a while. So I think we certainly are seeing that kind of medium-term trend. I would say we've seen a kind of a second wave of interest on the back of a belief that there's going to be meaningful capital spend, perhaps on the defense side, in Europe and in the UK. Really on the back of statements coming out of U.S. administration as to whether or not they continue to be supportive of NATO and things like that. So I think two different reasons, but I think non-euro denominated investors, there's certainly been a meaningful uptick in interest in strategies over here. I think that probably has more to do with the rates and general geopolitical environment than FX, but perhaps partially due to FX as well.
Thank you for satisfying my FX question. And Daniel, finally, over to you.
Well, the interesting part is the second part of your splitted question. It's about the outbound investment.
Correct, that's right, yes.
And, well, we heard it in the panel before, I guess the gentleman here said, and it's quite interesting. And when you followed the fireside chat, it was quite interesting to listen, not only think about that investment can come from GCC, can vice versa on the other side, so that the UK or European investors can invest in the GCC region. And quite interesting, this part of your splitted question. Yeah.
Perfect, thank you. Look, I'm conscious of time, and I think we're coming to the end of our discussion this afternoon. So sort of the final question, I think this is pretty obvious. You don't have to be a rocket scientist in terms of the last question I'm going to ask you, but I'd like to ask the panel, and then we can go sequentially down the row here, starting with Alex here. What macro indicators or trends should investors be watching most closely over the next 12 to 18 months?
I think ultimately it's just confidence. There is something called Google it called the Global Uncertainty Index. Right?
There is, that's right.
And it's not very well known, but it's a bit of a no-brainer. So for me, it's really around lack of uncertainty and confidence, and I'd like that ultimately needs to be telegraphed by probably more stable currency, more stable domestic politics, and the equity markets will start telegraphing that straight away. But for me, it's lack of uncertainty. I'm not hugely convinced that we are in any less of a stable UK political environment than we were a year ago. And I don't think that the uncertainty and the volatility piece is going away anytime soon. But I think it may well be a case of investors just getting used to a sort of a longer, more prolonged narrative around that. Investors can, it's more uncertainty around uncertainty, if that, the tautology around that, if that makes sense. That'd be my big thing.
Okay, thank you. James?
Yeah, I think consumer confidence, I think, is a great one. I would agree with that. I think paying attention to consumer confidence, I think ultimately, deficits, because I think, it's going to be deficit spending that perhaps kind of drives the inflationary story from here. And then as we think about our portfolio, we're obviously laser focused on tenant credit quality, and how how our tenants' credit quality is is evolving over the course of our investment period. So, general corporate credit trajectory, consumer confidence, and spending.
Agreed. Definitely consumer confidence. With that, the strength of the U.S. dollar. I think, again, my view, it's going to weaken from here. So it should be interesting. But, definitely an interesting time, the next 9 to 12.
Thank you. And finally.
Well, you asked for the impact of
I did.
These, things, and well, I guess each investor must have looked for the impact for his sectoral investments, and but what you said already, it's confidence. I guess it helps you to go through that.
So I think, look, in the discussion that we've had in the 40 minutes with you, quite a few themes have come out. But if I may summarize, sustainability and the consideration of sustainability in real estate, I think, is a common theme that's been running through the day. I think everyone's acknowledged the political challenges of the turf that where investors, especially in the real estate space, have been sort of historically more aligned to. And I think in the first time in a long time, there seems to be a little bit of a delta between various objectives. I do agree the UK is in a completely uncertain time at this point in time. Whether you agree with it or not, at least the US, they kind of know what they want to do and how they want to get there. As I said, whether you agree with that is not here or there, but at least it's a little bit more clearer than the UK that tends to do various U-turns every sort of couple of weeks on any sort of policy that comes in. Obviously, interest rates, again. Some of you remember a popular program from many years ago, The Price is Right, or Play a Card Higher, Lower. Looks like the US may either go flat or be a little bit higher. The UK and Europe are looking to compress interest rates. And then look, I think as an investor for always has multiple degrees of freedom, right? That they're looking to steer them towards the best ROI at the end of the day. That's why you invest, right? You want to work your capital as best as possible. But I think it'd be quite interesting to come back in 12 to 18 months' time and see what everyone's view. I think it'll be a very, very different world. I think a lot of things will eventually, like a good bottle of wine, breathe and take a bit of time from that perspective. So, look, I'd like to thank our panelists for this afternoon. I think there's some rich, insightful, you've got leaders in their field here this afternoon that really know their stuff in complete. And I've learned a lot for a simple FX guy that I am, right? So I'll take that away from my own personal consumption. But let me open the floor to questions, if any, before we move on to the next session. To ask our panelists their views on anything that's been raised that caught your attention, please. Don't all ask at once.
How are you dealing with assets that are essentially becoming dead? That sounds a bit harsh. Did you hear that?
I got that. How are we dealing with assets that are essentially becoming dead? And I'm going to come at this more from a private equity side of things, but it ties into kind of other longer term illiquid asset classes. There's a huge sub-industry that has developed in managing off and taking on assets that have become dead. It's an entire eco-structure in its own right. So we've now have, on the private equity space, but also on the real estate side, we've got a whole very vibrant secondary market emerging, and now even a tertiary market. So, there is, I think, to coin your phrase, Khalid, the price is right. Come on down. There is a market for everything. The challenge is meeting seller expectations on those assets, and there's generally a very significant gulf between that and reality.
Thank you.
Anyone on the panel would like to?
Sorry, I'd rather dominated. Okay. Can I just say, Khalid, on behalf of the panel, thank you very much indeed for, you're not just a simple FX guy, not at all, but thank you very much indeed for awesome planning and moderation on the day. Much appreciated.
Thank you. Much appreciated.
Great.
Thank you, everyone.
Thank you.
Take care.